Good afternoon, everyone. I'm delighted to be here. I'm Martha Stokes. This is a MetaStock sponsored webinar. Kelly is having a little bit of technical difficulties, so he isn't able to start this today, but we're going to be talking about high performance trading simplified. If you're having any problems with the audio or the visual, please let my people know. I have Adrienne standing by, I have Howard standing by, and Andre also helping us, as well as Kelly at MetaStock. This is our copyright notice, and all the charts are presented from MetaStock Eclipse. This is our disclaimer. You've all seen this before. I don't recommend stocks. I'm not a guru. I teach you how to find your own. The workbooklet for this hand-on training, you can go to our website. That's the icon. Click on that. You go down to this site, and right here is where you download the workbooklet. If you don't have it now, don't worry about it. You can get it afterwards and see it. This webinar, as with all our MetaStock sponsored webinars, is being recorded as I speak. It will be available for viewing no later than Monday. Sometimes we have some editing issues, so it may be up sooner than that, but I will say that it will be up by Monday. Questions and answers. As always, this webinar is jam-packed with training. I realized that I had 3 hours worth of training to cram into 1 hour. So in order to get through all of it within the allotted time, I will answer questions after the webinar presentation. Again, if you have any difficulties during the webinar, my people are here to answer your questions. If we run out of time to answer all of your questions, you may email info@technitrader.com, and your question will be forwarded to me so that I can answer you directly. Students, please use the support email address. Direct answers from me will be available for about a week to 10 days, okay? All right, hands-on training. My goal in teaching is to give you tools and skills you can use in your trading to enhance what you already know. The best way for you to learn is not simply to observe, but to participate in the training. We are going to cover a lot of information quickly during this webinar. I do speak quickly, but you will have the review of the video later on, so don't worry about it. Please take notes and write in your workbooklet now if you have it. If you have less than 2 years of live experience trading, you will feel overwhelmed at times during this training. This is normal. Take one aspect of the training and learn it well. Don't try to learn everything in one brief hour, and of course review the video afterwards. Advanced traders, take notes. You only retain about 20% of what you hear, and a lot of times I find that people don't remember things accurately. It's really important that you remember and write down things accurately. Write in your workbooklet, keep it for future reference to create your trading plan. Every so often I have time to visit the New York Stock Exchange. Being on the floor of the most prominent exchange in the world is a very special experience for me, a very great experience. My dream is to one day to be able to take a group of my students to the New York Stock Exchange and hold a live workshop there. The first thing I do when I get on the New York Stock Exchange floor is to go around to each post to see how they are trading. And I speak with as many floor traders and specialists as possible. What I find is this: each professional's trading plan or process is unique. No two are alike. Unfortunately, when I go to various retail trading groups or do an individual consultation to help a trader who's struggling with inconsistency, what I find is that hundreds of retail traders, or thousands, are all using exactly the same trading system they learned at some weekend seminar or online during a webinar such as this one. And that makes retail traders vulnerable to what I call, to what all professionals avoid, the cluster order syndrome. This causes the inconsistent results and chronic losses that erode not only capital, but your confidence as well, which is so important. You have to be confident in what you're doing. In order to understand this phenomenon, which is relatively new to the markets, you must first understand the current market structure. The structure of the financial markets has changed more in the past 10 years than it did in the previous 100 years. The market structure has changed so fast that many retail traders are stuck using outdated systems without knowing it. You're back in the 80s and 90s, and you don't realize that you're trading out of the market structure we have today. High-frequency trading firms have grown in size and market scope since 2000. HFTs use formulas to track order flow. This is a high-frequency desk, and as you can see, they don't have any charts. They use strictly formulas. They're tracking order flow. They're looking for order flow anomalies, and that's how their automatic triggers go off. High-frequency trading firms are trading on the millisecond. That means every second there's 1,000 trades firing off. Every minute, 60,000 trades are firing off. You trade on the minute scale, they trade on the second scale. So you cannot trade against them, and you need to be sure that you're on the right side of the trade and be trading in accordance with how they're trading. Professionals have proprietary trading processes that they protect and keep private. I can guarantee you that the floor traders don't sit around and gab about their processes and their proprietary trading systems. They keep it very quiet and very secret. Most trading systems use the same strategies, popular indicators, or signals. So all retail trading systems are all using the same strategies. They're all using these popular indicators or signals at the same time. So all retail trading systems are all using the same thing. High-frequency trading firms use these popular indicator formulas and strategies to find anomalies in order flow. When cluster orders are identified by the QA formula, it triggers automated electronic orders that cause whipsaw action in retail trades. So if you still think that the market maker is sitting around waiting for you and your little stop loss and your 100 or 1,000 share lot order, you are way back in the 80s. Right now, high-frequency trading firms have replaced the market maker, and they are the liquidity of the market. The normal order flow pattern is somebody has an at-market order, so they're brought in high. Then we have orders that are controlled bracketed orders, and we have orders like many retail traders use, the limit order, which gets them into the stock as it's moving down. So the normal order flow is random because there's so many ways, so many different types of orders that you can have, so many different time frames, and so many share lots. Cluster orders occur when everybody starts trading the same, and this is what the professionals absolutely try to avoid. Retail traders systems don't avoid this, and this is what we're going to talk about tonight, how to avoid this kind of condition, which causes the whipsaw trades that most of you experience. Now, the dark pools are relatively new. They've been around for a while, a few years. The institutional investors buy with a bracketed order. Don't buy me in any higher than this. Don't buy me in any lower than this. So they have a controlled bracketed order. They're trading 100,000, 500,000 share lots, but they're not trading it on the exchanges anymore. They're using the dark pools. What a dark pool is it is an over-the-counter transaction between a broker to broker, broker to institution, institution to institution. They're perfectly legal. They're going to be around for a long time because they're not trying to hide from you. They're trying to hide from the high-frequency trading firms' formulas because their controlled orders are a kind of cluster. So what they want to do is they want to get into the stock and buy all of the stock, millions of shares that they want, and then they let leak out that they've been buying the stock, and just like famous retail gurus, then everybody runs after and buys the stock after they've got in. So you want to avoid this, and that's what we're going to talk about today. There are thousands of stock trading tips and webinars, YouTube videos, articles, commentaries, recommended stock lists, gurus, etc. on the internet for you. There are hundreds of stock indicators and many different types of charts you can use. There are dozens of drawing tools. So why is it that 80 to 90% of all retail traders struggle to be consistently profitable, whether they're trading stocks, options, forex, or whatever? Why do so many retail traders endure chronic small losses while clinging to the hope for another great big profitable trade? Why, after 16 years of online brokers, online trading, seminars, and webinars, is the retail trader still not successful? Because they're all stuck in the crowd mentality. Think about it. How many webinars, seminars, videos, articles have you watched or studied? You can learn every strategy. You can learn every indicator, buy or sell short signal. You can take every seminar, webinar, read all the information available on the internet if you have the time. You can try trading options, forex, E-minis, ETFs, futures, and commodities, but you will not be as successful as you deserve to be until you develop and use a trading process that is right for you, that is simple, focused, and refined. People often bop from one these are trading instruments, options, forex, E-minis, ETFs, futures. They bop from one to another because they're never successful. If you can't make it successful in one, then you need to stop and reconsider how you're doing the whole entire process. So this is what we're going to talk about today and move forward on that. Today we're going to go through the criteria you need to develop your own unique trading process so that you're trading like a professional. This webinar is all about creating a high-performance trading plan. Retail traders need to learn how professionals actually trade the market. It is totally different than most retail traders imagine. The professionals, high-frequency traders, exchange floor traders, specialists, institutional traders, or independents all have a trading process that includes rules and parameters that comprise their trading plan, and they don't deviate. They may adjust and modify to market conditions and changes, but they have rules and parameters, and when they go into a trade, they stick to them, and that's why they're successful. You are using a powerful charting program, yet most of you are not trading like a professional. You're still following the herd mentality, trading with the crowd, chasing stocks, reacting to news, and making mediocre profits, and tolerating chronic losses, which you should not do. If you want to be as profitable as a professional, you must develop a trading process that is your own. Here's how you do it. Learn the basics of market structure. What continually surprises me, even after all these years of teaching retail traders, is the lack of basics. Most retail traders do not have a foundation of knowledge from which to build an individual trading style and process, let alone a complete trading plan. So today we're going to review a couple of basics you must understand before we proceed with creating your unique high-performance trading platform. As an example, this is VBY a few days ago, and I know by looking at my trading plan and how I trade that this stock is going to move up. I haven't had a chance to take a look, but all of you should take a look at VBY and see if it did not move up from this area. Okay. One of the things that surprises me a lot is I was recently at the Money Show as a speaker. I do speak there periodically. And I said, how many of you know about the Dow theory? And one person out of a whole huge group raised their hand. So we're going to go back to the basics of this. You should know this. The Dow theory was written by Charles Dow in the 1890s. He was a writer for the Wall Street Journal. He wrote several articles that became the Dow theory. It is the basis of all technical analysis. It is the premise for Elliott wave. It is why we use Fibonacci at times. It's why Gahn developed what he did. It's what Graham has built the foundation on. All of the technical analysis that's ever come out of the market started with the Dow theory. And his theory was that the informed buyers, the bankers, the underwriters, the wealthy individuals and corporations accounted for 50%, and they came in low as the first wave of activity out of a bottom. Then the second wave was average middle-class Americans who invested, and they came to about 40%. And the uninformed investor, people who don't know anything about the market, but they see that the market is running up and running up and running up like it was just before this recent short-term correction we have, and they're rushing in to buy at the peak just before a correction occurs. So this was the market of Dow. And this is the problem that most of the trading systems you have out there, because they're basing everything on this outdated version. This is the cycle of market participants we have today. There are 9. I've just added the 9th. I wrote this in my CMT. This was part of that. In the first lower group is the institutional investors, wealthy individuals, corporations, high-frequency trading firms, institutional traders. These are the big heavyweights. They have millions, billions of dollars to trade. They control trillions of dollars in the market, and they know what they're doing. They all have different agendas. They all have different methods and approaches. Some are fundamentalists. Some are technicians like institutional traders. High-frequency traders are formula-based trading, short-term trading. Corporations are buying companies or investing, or they're using it as a means to balance out their earnings because they are a cyclical company. They control 80 to 90% of the trading activity, depending on how many of the cycle of market participants are active in the market at that time. They're not all active all at the same time. That changes the market's conditions. The smaller fund groups, small funds, retail traders, you way up here, and individual small lots and odd lots constitute 10 to 20% of the market, and you control the end until the institutional investors start selling out. I don't have time to go into this into more detail, but there's a lot of this that you really need to understand, because every level that goes on, someone is controlling that activity by how they buy, their agenda, and their intent for that trade. And the downtrend is the opposite. Institutional investors are the first out. They wait for all the small lots and the odd lots to be buying, and now they're rotating out. That's why we have this correction right now, because they got really heavily weighted. A lot of stocks had 95 and 98% institutional ownership. That's way too high. So we knew that it was going to correct. There was no big, that was no-brainer to call that one. Odd lots get out at the bottom while the institutional investors are creating the bottom. Okay? So you need to understand this so that you know where you are in the trade. So the second aspect is after market structure, understanding market structure, you need to create a complete trading plan. A trading plan includes selection of your trading styles. I'll talk about that in a minute. Establish a written set of rules and parameters for your trading style. Set up indicators for each trading style. Identify which market conditions are optimal for each trading style you will use. Use market condition analysis explorations. I'll explain that in a bit. Set up MetaStock tools with shortcuts to streamline selecting and analyzing your stocks. You can set up little icons down below on the bottom of your chart, and you can just rapidly click from one trading style to one indicator to another very quickly, making it a high-performance trading system. Set up your risk analysis tools and order execution tools. And some of you are going, what are those? You need to have these because these are things that really speed up the whole process, and high-performance trading is all about speed, reliability, focus, and consistency. To streamline risk assessment throughout the duration of the trade, you must be constantly assessing your risk versus your potential gain so you know when to exit the trade. What is a trading style? Intraday swing, intraday scalp, not used much anymore these days, but some people are still doing it. Day trading, which is one-day hold. Swing trading 1 to 10 days. Position trading a few weeks to several months. Options premium, similar to swing trading. Options execution to enter the stock leveraging through an option. Options positions, similar to position trading, are all short-term trading styles that you have available for stocks and options. A trading style defines what share size lots you will use. Different trading styles require different size lots to be successful. As an intraday trader, you need much larger share lots than you do as a position trader. Which indicators you should use based on market condition analysis. Swing traders and intraday traders have different kinds of indicators you would use and different time periods. What entry or exit signals you will use. A swing trader is going to use a very different entry than a position trader. What type of stop loss you will use. Intraday is using intraday stops. Sometimes swing traders are using intraday stops, but a position trader never would. What type of chart patterns you will use. You have to use chart patterns that are recognizable to you and are good for your trading style. And chart patterns are stair steps, peaks and valleys, rolling, that type of thing, not up, down, and sideways. What market conditions you will trade aggressively and which you will trade conservatively. When the market is moving with momentum and velocity, swing traders and intraday traders want to be in there aggressively. You want to be aggressively trading. But when you go into a platform positioning or inconsistent, you want to be trading more conservatively in those trading styles. The risk versus profit potential of the trade, how much you should be expecting to get from each trade based on your trading style. Your price range, you need to narrow that down so you just get just the right price range for your trading style, your capital base, and time requirements. Some trading styles require a lot of time. Position trading requires the least amount of time and is hugely profitable. Finding stocks. You should have an exploration that is designed to find stocks based on the market condition present at that time and your trading style. The exploration should have sort capabilities to bring the best stocks for that trading style to the top of the list. And I'll show you some examples in a little bit. The exploration should contain a small number of stocks with technical patterns and entry signals that are most reliable for the market conditions present at that time. Using price patterns such as candlestick entries rather than indicator crossovers, because indicator crossovers are based on moving averages most of the time, and moving averages lag in our current market condition. Example, resting day patterns are most reliable in stocks moving with momentum, where the institutions are holding and waiting because they're already in and they're just sitting around waiting for news to propel price upward, as retail traders and small lot investors rush to buy after the news is released. So you want to get in on resting day patterns as opposed to a springboard or a pole vault or one of the other engulfing lights. You want to get in on a resting day pattern. So what is the resting day pattern? A resting day pattern is a very small candle. It's also showing tremendous activity down here with the institutions before it starts to move up. So you want to get in as the stock is moving up. You always want to be buying into strength. You want to have explorations that pull these up for you and that you can find and and take advantage of. Okay? Strategies, stop losses, and risk analysis. Most retail traders that start training with me have an incomplete trading process. They don't have what they need to really have a complete process that's successful. Usually what they have are several strategies they have learned, tossed together with some popular indicators that they do not fully understand. Then they incorporate an outdated stop loss procedure, such as a percentage stop loss, and make it worse, aggravate it by using limit order. And they have little to no risk analysis involved at all. They are setting themselves up for ending up in a cluster trade whipsaw activity. So what I see is I see a whole lot of jigsaw puzzle strategies tossed together with some indicators, and I have to sort this out and actually create something that makes sense out of this for them so that they can be as successful as a professional. Market condition analysis is the third aspect that you need to consider as part of your trading plan and trading process. As you can see with the NASDAQ, the market conditions change over time. Trading range, bottoming, moderately trending to the velocity, all these things change over time, and you need to be aware of this and continually be tracking what the market condition analysis is. So what is market condition? When I first introduced the concept of market condition analysis to active traders, they always think I'm talking about market breadth, or advanced decline, or market cycle, or McClellan oscillator. I'm not. I'm talking about market condition is far more extensive and more sophisticated than any of the standard market indicators, which many, by the way, are outdated for the current market structure because they're based on price and time. Most market breadth indicators nowadays and the major indexes lag price action. Why? Because the giant institutions already own all the S&P stocks they're going to own, and they're holding them for their charter for long term. They're actively trading small lots, small caps, mid-side caps, and new technology stocks. So that's where their action is. And that's all going on, and maybe the major indexes are all sitting there looking kind of dopey or insipid, not doing much at all, and underneath all this action is going on. So if you're following the indexes, you're missing out. So market condition analysis tells us who is in control of price, what technical patterns are most prevalent, platforms, peaks and valleys, stair steps, how price will behave at resistance and support. It changes at a bottoming market. Is very different how resistance and support behave than at a topping market. What trading styles will work best. What indicators to use. You don't want to use an oscillator in a momentum or velocity market because it'll get you out too soon. The inherent risk of trading specific styles. Some in a platform market, and if you try to trade that tighter platform range, you're going to get whipsawed out. It's higher risk for swing trading in a platform market. You have to learn how to trade that with a swing. What trendline patterns are most common? What entry and exit signals are most reliable? Just because you see an engulfing white doesn't mean it's going to be reliable in that particular market condition. In other words, market condition analysis tells you how and when to trade. It tells you who is controlling price, critically important, and it tells you what to expect in near-term price action, which is what short-term trading is all about. It tells you where to find excellent picks and how to enter and when to exit. So, which market participants are aggressively trading the market at this time? The large institutional funds are rotating out of some stocks that they're overweighted in. In other words, who are you trading with and who are you trading against? High-frequency traders are selling short. Which market participants are not actively trading or investing in the market? Right now there's no buying going on by the institutional investors because we're peaking and they're waiting for a better bargain. Small lots were buying and now they've kind of faded out. Which impact does this have on price action, price follow-through, and sustainability of the run up or down? There are 6 market conditions: bottoming, platform, moderately trending, velocity, trading range, and topping. I don't have time tonight to go into them. Each is distinctly unique as each has a different market participant group or groups in control of price action. Okay, your MetaStock explorations for market condition analysis. I put together some for my students. The momentum buy side, I'm asking how many stocks are moving to the upside with strong momentum. Then I'm saying on the sell side, how many stocks are moving with strong momentum to the downside. This tells me whether the buy side or the sell side dominates. Now, we've had a couple of days of bounces going on here, but for a while, the sell side still dominated, even though we have a bounce. That's important to know. You need to know the bias of the market on the short-term end. So by comparing the number of stocks that are moving up versus the number of stocks moving down with momentum gives you tremendous information. Institutional activity tells me if the institutional investors are investing quietly and not moving price, because they don't move price. Institutions investing have a controlled bracketed order. They don't move price. Institutional traders do move price. I want to know if they are. I want to know if the institutions are just sitting on the sideline, which they are right now. They're sitting on the sideline. Bottoming stocks tells me how many stocks are in short-term or intermediate-term bottoms. Very important for short-term trading. Consolidating stocks, how many stocks are in consolidations? Tighter sideways action, stair steps, longer sideways action. How many are in that? That tells me a great deal. Overbought tells me how many stocks are at the high of their trading range or topping. Right now, the overbought scan is very low, so we know we're not completely at a top yet. RSI market condition tracks platforms. When a platform starts to compress, it's accelerating and it's going to have a sudden move up or down. So this tells me how many stocks are moving with that. By quickly comparing the number of charts that each exploration pulls up on any given day, you can easily determine what market condition is present at that time. From there, it's simply a matter of using your MetaStock preset tools to find stocks that will outperform your normal retail trading systems and keep you out of cluster orders. MetaStock Charting Software contains all of the tools necessary for you to create your unique trading style and process. It's got tons of stuff. I'm always amazed every time I go in how much stuff they have. They have indicators that are the eminent domain or the standards that everybody knows and uses, and they have proprietary indicators, and some of ours are in there too. They have chart types, Western and Eastern. They have the most chart types that I know of. Trend drawing tools, tons of trend drawing tools. You can choose which one that you want to use that works for you. Layouts for chart types, indicators, and time frames. You can have as many as you want. Fundamentals, financials, institutional holdings from Reuters, tremendous. All kinds of indexes, all kinds of sectors, all kinds of global exchanges. Full of stuff to make your trading style and process totally unique. Okay, number 4, you got to focus on indicators. We're going to spend a little bit of time here because it's so important. What type of indicators should you use for the current market condition and what settings? MetaStock has a vast library of indicators available for you to create your own custom trading plan and process. You don't have to use the most popular indicators. You got tons to choose from. During my years of research for my CMT, I studied over 250 indicators individually and many, many charting programs. To my knowledge, MetaStock has the largest library of indicators all in one charting system, totaling over 325 standards plus a whole bunch of proprietaries. In a few minutes, I will show you how I grouped the indicators for a faster way of screening down what to use. TechniTrader developed 5 indicators specifically for MetaStock Charting Software, and these indicators are exclusive to MetaStock for my students. They're proprietary. I do not want the high-frequency traders to find them and use them, so they're kept proprietary. In order to use any indicator properly, you don't need the formula. What you need to know and understand is what financial market or financial instrument for which the indicator was written. The indicator category, what data is used in the formula, what market condition was underway at the time the indicator was written, and the intent of the indicator writer. What was his intent? What was he trying to reveal with that indicator? What are the limitations of the indicator? Every indicator has its limitations, every single one, and you need to understand that. Whether it is for intraday, short-term, or long-term analysis. A common problem with a lot of people that I study their problems and they're having inconsistency, they're using a long-term indicator for intraday or short-term trading. Bad idea. What indicator patterns form and what each means. You have an indicator chart, and the highs, the lows, the way the line forms or the way the histograms form tell you a great deal. You need to be able to read them like you read a book. Under what trading conditions does that indicator work ideally, and under what does it fail? You need to know this. And which subordinate indicators to use with the indicator, if any. We're going to go through this in a little more detail. So the primary groups of indicators in MetaStock are, they have many market indicators. They have tons of stock indicators, options indicators, which are great, forex indicators, specialty indicators, commodity and futures indicators. Because time is short, we'll be studying stock indicators for this webinar. So the data that's available, if you've chosen stocks and or options as the primary trading instruments you are going to use, then the data you need to have a complete indicator analysis are all on the ticker tape. Price of the stock, time the trade was executed, quantity of shares traded, whether the trade was an uptick or a downtick. Quantity of shares is, was it 100 shares, 1,000 shares, 5,000 shares, 100,000 shares? It matters. And you can analyze it. Data used in stock indicators are price, time, and quantity. This is the data used in all stock indicators. Two data are needed to create a stock indicator, either price and time or quantity and time. Price and time indicators lag to some degree. More and more, they're lagging more and more often because institutional funds, institutional traders, the big powerhouses that have billions of dollars to trade dominate. And so you track them with quantity and time. Quantity and time indicators sometimes lead, but price, time, and quantity indicators, the new indicators, the more recently written indicators, lead most of the time, and that's where you need to put the emphasis. When I look at a trader's list of indicators that he's using, he's got most of the time price and time, price and time, price and time, price and time. Most of the time he'll have volume, but most of the time I see price and time and nothing else. And that's why you're not doing so well. So if you want a high-performance trading system, you got to have price, time, and quantity indicators and a whole lot more time and quantity. So on the MetaStock chart, we have time and a couple of variables. We have quantity. This is one of the indicators rewritten. It tracks the institutional investors, institutional traders. It tracks large lot versus small lot. It's very useful. We also have price and candlesticks, or whatever charting chart system you want to use. And we have price on the side. So we have a lot of information right on the chart. I like clean, simple charts. Moving average was the original indicator, the first indicator ever written for stock analysis. And they are a smooth version of price. They are a subordinate indicator because they are an indicator based on price. So we're going to go through this quickly. You'll have an opportunity to go through this again when we have the webinar posted. So trend is basically, is the stock trending or not trending, moving sideways, but also more modern trend indicators are going angle of ascent or descent and the speed of that. Velocity indicators are acceleration, volatility, momentum, mostly price. One or two volume are available here. Trend is all price and time. Quality, volume indicators. Quality or volume indicators, the strength, the continuation, duration, and sustainability of that trend. Oscillators come in two versions, price, overbought, oversold. You all know about these. But there's also volume oscillators, which most of you don't use, and you need to start incorporating them. They'll make a huge difference in your trading. Overextended, increasing or decreasing energy, critically important to use both of these types of oscillators, especially in trading range markets and that type of thing. So we also have accumulation distribution. This is large lot activity versus small lot activity. That's that histogram indicator I showed you earlier, TTQA, that we created for MetaStock. It compares how much large lot activity we have versus the smaller lot activity. The hybrids, indicators that provide more than one confirmation, include all three pieces of market data in a more complex formulation most of the time. So the hybrids are the newest, latest indicators. They are designed for the current market where the institutions dominate so much. Cycles reveal cyclical patterns in some stocks, and the subordinates applied to primary indicators. The subordinate compares not price, but it compares the indicator on which it's applied. So in MetaStock, these are some of the price and time indicators. So there's a whole bunch of them. And we can see that, yes, in the past, price and time indicators were the most important, because in the days when average investors and traders dominated, that was the more important indicator to have. However, price and time indicators are the most prevalent indicators, but they fail to include two of the most important pieces of data that comes from the market today: quantity and time. Quantity has become critical data for highly profitable short-term trading in the electronic marketplace. Quantity defines who is in control of price. Is it the heavyweights? Is it the big institutions controlling price? Or is it the smaller lots controlling price? At all times, you need to know who's in control of price. If you're trading with the smaller lots, you're going to have whipsaw trades, mediocre results, smaller profits. If you're trading with the big lots, you're going to have much better control, and you're going to be a whole lot happier with what you're doing. So when we get to volume and time, suddenly the number of, and this is true of all charting programs, there are fewer volume and time indicators written, but they're still incredibly valuable. You've got to have volume. I would recommend a volume oscillator. I also like volume rate of change. Subordinate indicators and specialty indicators are applied to primary indicators and derive their formula interpretation from the primary indicator pattern. So subordinates can't be by themselves. They have to have a primary in order to function. Subordinates should be used with most primary indicators, particularly those that are one line or are a histogram. So if you have a one-line indicator that you're using, apply a subordinate to it. Specialty indicators are channels, bands, comparison like our relative strength, and specific application indicators. So subordinates are like Bollinger Bands, envelope, linear regressions, moving averages, that type of thing. So you can use those to improve and speed up your analysis. You should never have a single line indicator. You should always use a subordinate with it or another primary to help you see what's going on faster and make faster analysis. The whole idea with a high-profile, high-performance trading process is that everything's at your fingertips and you can move on through the charts at rapid speed. Okay, here's an example of a subordinate indicator down here. This is our volume accumulation indicator. This is an oscillator that oscillates. So I want a moving average that oscillates with it to some degrees, and it can show us positive and negative divergences and other things that are going on. And it can also show us extreme volume patterns to the upside, extreme volume patterns to the downside. So that gives you a tremendous amount of information. Okay, the volume, time, and price indicators are also very rare. There's only a few, plus the ones that TechniTrader has included in MetaStock. So these are some of the volume, time, and price indicators. They include all three. They're superior indicators to price and time. Hybrid indicators. Hybrid indicators combine all of the data into a more complex formula with the use of subordinate indicators. Price, time, and quantity are calculated in such a way that the indicators actually lead price action most of the time, providing invaluable information for short-term trading. These are the most sensitive indicators for today's electronic order flow, which is dominated and controlled by institutional investors, traders, and so on and so forth. So this is our flow of funds, and this is our volume accumulation. Again, these are hybrid indicators designed to track all kinds of things. Our TT quiet accumulation, again, tracking price, time, quantity, large lots, upticks and downticks, small lots, upticks and downticks. And then our volume bars, which we have applied a moving average so that we have better analysis of what is above or below average for that stock. Hybrid indicators are designed to lead price. In other words, the indicator signals in advance before price starts to move. How do they do that? Because volume is flowing in, and the institutional investors do not move price. So as they're moving into the stock, they let you know they're moving in before price moves. TechniTrader hybrid indicators include quiet accumulation, volume bars, volume accumulation with centerline oscillation, and then I have a very special RSI variation with center oscillation that I also use. So these are our hybrids we have added to MetaStock. Okay, so essential indicators in summary. In today's electronic marketplace, you must use certain indicators in order to analyze a stock pick properly and thoroughly for your trading style and the market conditions. Also, your indicator sets must have indicators for all the market data, not just price indicators, because you will always be miserable if you do not change. You need quantity indicators more than you need price indicators. Quantity indicators encompass several categories of indicators: quality, accumulation distribution, volume-based oscillators, flow of funds indicators, and the hybrids. So your indicator sets, if you use more than one type of trading style, you will need to set up a set of indicators for each trading style with appropriate periods and settings. Let's say you want to do swing trading, but then when the market platforms, you want to do position trading. You need a set of indicators for each set of MetaStock ready to go, so you can just switch from swing trading to position at will. I also use sets of indicators for 6 different market conditions to analyze if I need to do that as well. By setting each up as a template in MetaStock, you can streamline your analysis, switching trading styles or adjusting for changes in the market condition at will very quickly. So you have your icons down below and you just click, 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 and your analysis is that fast. It really speeds up and makes a high-performance trading process. So let's talk about explorations. These are the explorations that we have written. We took a couple of years to put all this together for MetaStock, but I'm very proud and pleased with it. You can see our market condition analysis and explorations are right here. And then I have specialty ones for the different trading styles. Explorations based upon hybrid indicators, which is what we've done, provide a significantly better list of stocks over simple price and time indicators, which most people use when they're putting their explorations together. By incorporating key elements of quantity, including large lot activities, even during flat market activity, the exploration will bring up a smaller list of candidates for your trading style. Smaller is better. You don't want to be looking at 1,000 charts a day. Explorations are an essential part of high-performance trading, so you want to set up explorations based on trading style using the quantity indicators, the accumulation distribution, the hybrid indicators, so that it brings up the stocks that are being accumulated quietly before price moves. Charting types in MetaStock. MetaStock Charting Software has the following options for charts. Line charts, the first type of chart ever produced. Bar charts, which was very popular before and is not so popular now. Point and figure is just price. It doesn't have time or anything else in it. It's just a trend-based type of chart. Candlesticks are the most popular for most stocks and options traders today because they're easy to read, they're easy to figure out. Then there's equivolume. That's based on volume. This, for some of you, may be extremely useful. Then there's candle volume, which is a combination of candlesticks and equivolume, which is combining 2 great charting systems together. And then you have Renkos. Renkos are very similar to point and figure. They're a price-only trend chart. Kagi, I'm not sure how to pronounce that, but Kagi or Kagi charts. They are a line chart that's based on trend. And then 3-line break charts also, Japanese version, similar to point and figure and the line charts where it's kind of a combination of line plus trend. So those are the different charting software chart options in MetaStock. So selecting the proper charts for your trading process requires that you understand first what data you must have displayed within the charts to have a complete data analysis for the trading style and trading instruments you intend to use in your trading process. If you're trading Forex, you don't have volume, so you would use a different charting structure. You should also only use those charts which clearly improve the technical analysis for your trading instrument that speeds up your trade analysis. Never use a chart type that does not include all the data you need for proper analysis. That doesn't make sense. Do not use a chart type simply because it is popular or because it seemed like a hot new chart type after you went to a seminar or webinar. A lot of people go to seminars or webinars and they see this hot new idea. They get all excited. They rush back to their trading system to use it, but it isn't going to work for them. So really know what's going to work and what isn't going to work. I don't care what exactly you use, just as long as it makes sense and it works with the market structure and your trading style. Choose and use what is right for you. Is easy for you to read and interpret and accelerates your analysis. Some people have a lot of spatial pattern recognition skills, so maybe some of the other chart layouts are going to be better for you than candlesticks. But most of you may find that candlesticks are easier to read than bar charts or whatever. So chart type selection. If you intend to trade stocks and options, we are back to the ticker tape data. The chart type you choose must include price and all its variables, time and all its periods and time frames. Why? Because we're dealing with a lot of short-term action. Quantity in all its forms, uptick, downtick, volume periods, large lot versus small lot. Why? Because the big institutions control, and they're large lots, and you need to know when quantity is moving into a stock. The question for any chart type is, what data does that chart type contain? How is that data displayed? Is the chart type and data easy for you to read? I don't care about your best buddy. I don't care about some guru who's told you it's great and wonderful. And I care that it works for you. Can you learn to interpret it quickly and easily, or is there going to be something that drags you down because you really don't get it? So let's summarize. How to create your high-performance trading process. Specialize. Choose one or possibly two related trading instruments rather than several. Stock and options are related. Stocks and Forex are not. So choose one or the other and stick with it. Do not change your trading instruments because you are not immediately successful. Switching to a new instrument means you're starting over. So if you go from options to Forex, you're starting all over again because they're completely different. The analysis of the charts, the way the market moves, what information you need, what fundamentals you need to understand, all change. Select your trading style or styles based upon your preferences for trading, your time available to trade, your capital base, your risk tolerance, and your experience, not somebody else's. All the time I see this where somebody is trying to trade like somebody else instead of trying to trade for themselves. All professionals trade based on this information. Use market condition analysis to determine how the price will behave and use the proper trading style, then select strategies based on that style. Most of you start learning strategies and you have no trading style selected. So you're using a strategy that's an intraday strategy and you're trying to position trade with it. Or you're using a position trade style strategy and you're trying to swing trade with it. It doesn't work. You have to start with the trading style and then you choose the strategies for that style. Use the proper indicators for the market conditions and your trading style. You have to use the right indicators. If you're going to use an oscillator and the market's moving with velocity, you're in deep trouble. Include indicators that clearly expose institutional activity, high-frequency traders, and so on. You can't use price and time anymore. I know everybody says price is the most important thing, but it isn't in our current market structure. You have to catch up to the times. Select the appropriate charting type for your style. Use explorations that quickly tell you the current market condition. Use explorations designed specifically for your trading style that will pull up a small number of charts for that market condition. Set up all templates for quick analysis of stock picks in your MetaStock. A high-performance trading process should allow you to find stocks to trade in 1/2 to 1 hour. Now, if you're a beginner, it's going to take you a lot longer. But if you've been trading the market for 10 years and you take more than an hour to find your stocks for the next day to trade, something is seriously wrong. Test your process on a simulator before going live. Please, please do this. Backtesting has limited value because you may be backtesting in a different market condition. You need to forward test. How do you forward test? You use a simulator and you trade as if you're trading live, okay? So let's summarize. The news is not your friend, folks. Avoid buying or selling short on news. By the time you hear the news, the institutions, high-frequency traders, and pros are already in the position and are planning to take profits against the retail trader of small lots. When Howard was day trading, before he retired early, we would watch, and anything on the news they would be going, oh, the stock is so great and wonderful, oh, you should buy Apple, and then while they're telling you how great Apple is, 100,000 share lots, 500,000 share lots, 200,000 share lots, just slamming through the markets. You don't see that anymore because they're doing it under the dark pools on the over the counter. So you day traders aren't able to see that anymore, but that's what's happening. They know in advance what's going to happen. Avoid cluster order syndrome by using indicators that are not part of the high-frequency trader formulas. I can tell you right now they use MACD, they use stochastics, they use them all the time. You using those indicators, you're going to periodically get caught up in the high-frequency trading firms. It's not the market makers, it's the formula trading that's getting you and attacking your trades. If you want to be part of the crowd, make sure you're within the institutions rather than the retail crowd. Make sure your indicators are weighted heavily with volume, quantity, accumulation, distribution, and hybrid indicators, not price indicators. That's the old style of trading. If trading stocks and options, the market structure dictates what indicators you should use. The market structure right now says you must use the quantity indicators more than the price indicators. Less is more when trading. Do not fall victim to traderitis. So many people get up every morning, I got to trade, I got to trade, I got to trade. That's traderitis and that's gambling. Don't do it. Trade like a professional. Specialists make more money than generalists in any profession. If you specialize, you're going to be trading like a professional. So use one, perhaps two trading styles, and don't mix styles. If you're swing trading, you should not be watching your stocks intraday. That's intraday trading. Keep it to swing, which is day by day. Use one or two trading instruments, no more. Use one or two entry signals instead of dozens. You do not need to use every candlestick entry ever invented. Choose those that work the best for you. I have a couple that I absolutely love. I love springboards. I mean, I can so get that signal. Do not fix what isn't broken. If you have a 60% success rate right now, improve what you're doing. Don't run out to the next seminar and switch everything up. Right now, Ichimoku is very popular. Everybody's switching to that. You've got to stay with something and make it work. Trade like a pro. Wait for optimal picks. Don't trade every day just to have something to do. Raise your expectations. You should have a 75 to 80% success rate. I am so disappointed when I talk to traders and they go, well, I just look for a 50% rate. Are you kidding me? Are you kidding me? Yes, high-frequency traders can make money with a 51% ratio of profits to losses, but they're trading billions of dollars every day. They're trading 1,000 trades a second, and so if they make a half a penny off of $1 billion, they can do that. You don't have that option. Write down your trading plan and adhere to your rules. Professional traders adhere to their own rules. Then simplify by eliminating redundancies. A lot of you just have too much redundancies. Throw out a lot of the news, get rid of a lot of the junk, and get down to something that's really streamlined and focused. Use MetaStock features to streamline your trading. You've got a fabulous charting program. Use the darn thing. You can set up all these things to go rapid and really go through. You can set up explorations for everything you need, and you can have great trading. Hone your trading plan and continually streamline the processes you use. Okay, we have a webinar special. You'll be receiving an email about that. You'll also be receiving an email telling you that there's a link to the video thing. So be sure and check that out when it comes through so that you can repeat and study this again, because I did have to go through it. I had 3 hours worth of stuff that I crammed into an hour, but I did want to give you a complete trading process from which to base things on. If you have any questions, you can email me or you can ask them right now. So Andre, do we have any questions?
Well, actually, I've got a little comment from Kelly Clement with MetaStock, and he's saying that MetaStock, for attending this webinar, is offering a free book with an article by Martha Stokes. You should all have in the little chat window, you should have a link there. It's metastock.com/ttbook, and they'll send it out to you for free. We do have, Evan was asking, since institutions buy at the bottoms, does the bottoming scan best expose institutional activity, or if institutions don't move price, is the consolidation scan better for finding out if the institutions are trading on insipid days?
Well, Evan, that's an absolutely excellent question, and I'm really pleased with your thinking process. What I look at is I look at the institutional scan, I look at the bottoming scan, and I also look at the consolidation scan, because they buy at the bottom, but they also buy during platform markets as it moves up. They do what a lot of really good wealthy investors, the billionaires of the world, which are increasing dramatically, they'll buy as the stock moves up in increments. As it proves itself over time, they'll add to their quantity of shares, the shares that they're holding. So they not only get in the bottom, they get up partway through as the market's platform, you can see. And when the market's platforming, you can pretty much count that there's institutional activity. You'll see that bottom, and then it'll move up with momentum and velocity out of the bottom, and then it'll move sideways again in this nice, fairly tight platform pattern that's 2 to 7 point range. It's not a trading range, and you can't swing trade it. because the platform is great for position trading, and then they'll move up again, they'll wait again, and they'll get in. So they get in at several points. So I do watch all three of those to see where they're at, and I do use the indicators that expose institutional accumulation versus institutional distribution.
Okay, and Joel says he has a difficult time deciding if he's going to be position or swing trading, or which style trader he is. What questions should he ask to determine which which style to use?
Okay, for a swing trading is a daily activity. You need to be up in the mornings checking futures because you want to avoid gaps. I talked about that on the Daily Market Educator today, that you use futures to avoid gap situations because you would pull your orders. No swing trader wants to get into a gapping situation. You want to be in before there's a gapping situation. And then end of day, you check everything end of day. You don't do intraday trading, but you need to be there early in the morning, and you need to be there end of day with the true end of day data. Now be sure and wait for the end of day data, because remember, the dark pools has to go through the clearinghouse, and then it's downloaded through routers into MetaStock. So you want to make sure you have true end of day data before you study that. And then you would be checking to see if you would be trading the next day or not. Position trading is like, you can do it one day a week. You can do it on Fridays or over the weekends, and then set an order, a good till cancel order, and then have that automatically fill you as the stock moves up out of the platform. So there's a lot less time. So time is a big question. Capital base is a big question. I recommend for most swing traders that you have about $25,000 to start with. I'd like to see more, but you have to have slightly larger share lot sizes for swing trading, because you're only going to be in it 1 to 10 days max. For position trading, you can have as low as $1,000 or $2,000 to trade and get in and hold, because you can buy stocks at a lower price and everything. Swing trading, your trading range to where the really great activity is somewhere between $18 and $50. That's where a lot of the great trading is. There are some higher price swing trading, but it gets pretty expensive at that point. So that's where the bulk of the swing trading activity occurs. So for position trading, there's the lower end also. And then your experience, how much live market experience, not how much stuff you've read and how many seminars you go. That doesn't matter at all. It's actually how many trades have you executed on the simulator, and what's your percentage of success. How many trades have you done that are successful and you make good profits, and how many have you taken small losses, and are your stop losses working properly, or are you still having trouble with that? Or there's some different things. So if you're a newbie, I always encourage position trading because it's lower risk. You can relax. It's not so stressful. Swing trading is I love it. It's a heck of a lot of fun, but it takes a little more skill level.
And I guess a follow-up question to that, what emphasis would you give fundamental analysis in swing trading?
None. The only thing that I watch for in swing trading is what the percentage of institutional holdings, and you can get that from Reuters. How much of the outstanding shares are held by institutions? If we get into the 90s and we see a whole lot of stocks with 95 and 96 and 98 institutional percentage holdings, they're going to start rotating out when the small investors start buying, and they're going to move to something that's going to move better and faster. That's just how they are. So I do watch that for swing trading, because that can often be kind of a precursor to a top at some point. It's not a precise thing, because that stock can move up and up and up and up and up because the small investors are buying it and pushing price up. But that's the one that I really pay attention to. Position, there are several different things that you need to pay attention to, quarterly earnings and that type of thing.
And Mohammed is following up, asking, what about money management and risk management?
Oh, yeah, that's a big part of it. But Mohammed, I really pushed the parameters of this, and I sped through this webinar to get as much information as all possible. I probably would do another webinar strictly with Howard, doing part of it as the money management and risk assessment and risk analysis and order processing, order execution, documentation of order, and that type of thing. That's a whole 3 hours all by itself.
Maybe we'll close with one more question. Mark is asking, you mentioned educating ourselves. Are there good references that you would recommend that are up to date with the new market conditions?
There aren't many. One of the reasons that this is, all of you need to know that I retired before I turned 40. And I thought that was the greatest thing that ever happened to me. And I thought, oh, because I started my first business at 9, so I was working at the age of 9 full-time and going to grade school also, and then going on tours and everything. So I thought, oh boy, this is going to be so great. I can travel, I can do all this stuff. And all of a sudden I was really bored. And that's when my partner Howard said, hey, why don't we do a workshop? And it's turned it. So this has become my retirement project to help retail traders, because it's so, you make a mess of the market sometimes. And I don't mean to be insulting. But if you traded better, the stock market would do better, and we would all make more money. So it's my retirement project to help you, because I find that so often what you find on the internet and in different seminars, and at the Money Show, I had this one guy was talking about how the market makers are trying to rip off retail traders, and I'm going, are you kidding me? I mean, come on. So a lot of the information, you have to be really, really careful, and you have to really check to make sure that the person you're dealing with first is certified, that they have some sort of credentials behind what they're saying, and that they have tremendous experience in the market, and that they're current with what they're doing, and not just espousing something that had been written in the 60s or 70s or 80s. You know, when has this stuff been written? Is it current with what's going on in the market? Does it speak about the market structure? Does it talk about the market participant groups and all the expansion of that? And then you will know whether you're dealing with something that's outdated or something that's current. Unfortunately, so many people, they don't realize that it just doesn't work in our modern markets. It's really changed a lot. I can't believe how much has changed. I spend many, many hours just trying to keep up with it just for myself. And then I share this with my students.
Well, if there were questions that you've written in on chat and they weren't answered already, then we will try to get those answered in an email to you.
Okay, I want to thank everyone for coming. I hope you enjoyed it, and get on those workbooklets and get your trading plan and process going, and really think about what you're doing. If you spend some time now, you will really be far more successful. Take the time now, and this will work much better for you. Thanks for coming. Bye-bye.